owners as a group have many things in common. They all manage money they receive from a direct group of people, such as participants contributing to a pension fund, or they manage money received for the benefit of a particular group, such as an endowment, which would manage the assets for a particular school. There are 4 types of asset owners. They include insurance firms, pension funds, endowment funds, and sovereign wealth funds. So all asset owners manage large pools of money for that particular set or particular group of recipients. They are custodians to invest, manage, and protect and grow this money on behalf of others. The pools of money they are managing are typically large, and inflows are on an ongoing and consistent basis, meaning they are typically recurring. For example, employees contributing money into a pension fund typically do so on a monthly basis from their paycheck. Money from sovereign wealth funds are typically from the sale of natural resources such as oil and timber, and again are recurring. In this regard, asset owners are slightly different than asset managers, who are responsible for making a return on their money, but asset managers get that money from multiple different and typically unrelated investors. Hedge funds, for example, will typically manage large pools of money, but they are received at one time, either the inception of the fund, or again, if the fund does another raising period, they'll get all the money at once and then it's invested. Additional money invested will typically only be when the hedge fund does another raise. Long-only investors, similar to asset owners, do get recurring amounts from individual investors, such as additional inflows from those adding to their 401k. Asset owners, similar to asset managers, do have sophisticated investment professionals who manage these pools of money, and these professionals are usually organized by asset class, such as equity or fixed income. So now let's take a look at different groups within the asset owner category. Insurance firms take payments, also known as premiums, from their customers and manage that money to ensure they can do 2 things. 1, have enough cash available to pay insurance claims of their customers as they come in. This could be from a car accident or a mishap with your house. It's the exact reason why people buy insurance, to spread individual risk across a larger group of people. Secondly, insurance firms take these pools of money and try and make a profit. Profit comes from excess returns that they make above the required payout amounts to their customers. This profit is for the insurance company and, of course, its shareholders. But there's many ways to make money. You could take all your money invested in very risky assets such as Bitcoin and hope for the best, but I don't know any insurance firms who do this. All insurance firms want to make a profit for their shareholders, but they all focus on risk returns and pay very close attention to the risk. They need to make sure they have enough money to pay out their claims. So many insurance firms will invest more in fixed income securities and manage the risk associated with changes in interest rates. There are many different ways to manage risk, but one particular term you may hear from insurance companies is asset liability management, where these firms want to match the duration of their assets with the duration of their liabilities. We'll go into this a little more shortly. Before we describe what asset liability management is, it's important to understand what types of insurance companies there are and what they do. There are many types of firms. Some insurance companies focus mainly on auto insurance. Some have auto and home insurance, the well-known bundle, and some focus on business and liability insurance, while others offer life insurance. Depending on what type of insurance the firm offers, you'll have different risk and a different liability horizon. So for example, an insurance company that offers life insurance will typically have a longer time horizon. They only need to pay out liabilities or a claim when someone dies, which is typically a longer time period in the future relative to an auto accident, which typically happens to someone, unfortunately, every day. So relating to this asset liability management term, a life insurance company will typically have longer liabilities compared to an auto insurance company. Their liabilities, i.e. when they have to make the payment to their holders, are further on average out into the future. So this is what asset liability management means. The asset owners will typically want to match the term of their liability payments with the length of their assets that they hold. In practice, how they do this is once they know the average liability length, say 20 years, they will also want to match the length of the time in their assets. So now going back to our life insurance company, in this instance, they will most likely have a portfolio that invests in longer dated maturity bonds because the payout to their policyholders on average will also be longer. By managing their assets and liabilities, they will be better able to insulate themselves against changes in fluctuations in interest rates and hence risk. Insurance firms will take measured bets on where they think interest rates will go and how the rate curve will shift, but as a starting point, they will want their assets and liabilities to be close in duration to manage the overall portfolio risk. Insurance companies don't invest all assets in fixed income. To get extra return, many of them also invest in some level of equities. Depending on the amount of risk that an insurance firm may want to take, they can invest somewhere between 10 and 30% in equities. They do this to increase their overall returns because, as I mentioned earlier, insurance companies get to keep the profit that they make. So they're incentivized to generate excess returns, but they have to do this in the context of asset liability management and risk control. So overall, insurance companies have to balance these two sets of constituents, their policyholders and their shareholders, and they do this through proper risk management of their portfolios. Finally, the structure of insurance companies, similar to other asset owners and asset managers for that matter, will have portfolio managers responsible for the overall performance of that pool of money and analysts who help the PM come up with new investment ideas and also help monitor the portfolio. As we mentioned, given the main focus of insurance companies is fixed income, and most who work on these types of portfolios will have a background and expertise in fixed income. Next, we're going to take a look at pension funds. As we mentioned previously, pension funds, similar to other asset owners, manage a pool of money with the hopes of making a return that will be able to meet the future payments required to be paid. When we step back and talk about pension funds, we need to consider what kinds of pension funds there are. Broadly, there are two types. The first is called a defined contribution plan. This is where each individual is responsible for investing their own money in their own retirement plan. They will typically take some part of their monthly salary and invest it in either stocks, bonds, mutual funds, or ETFs, however they see fit. This is essentially how almost all pension funds are structured today. The second type of pension plan is a defined benefit plan. And when we talk broadly about pension funds, this is the kind we're talking about. This is where employees, or the members, pay a portion of their monthly salary, and the institution manages that pool of money for the employees with the hopes they can make sufficient returns to cover the required payouts. This type of pension plan, or at least creating new ones similar to this, do not exist anymore. Historically, many industrial-type companies like Ford or some of the big railways had this type of plan. In this type of plan, the employees were guaranteed a portion of their salary once they retired for as long as they lived. And the guarantee was the real issue here. But many things happened with this type of plan. The main issue is it was difficult to meet the required returns to guarantee the future payouts. This could be due to many things, but mostly these pension plans were not able to meet the required levels of returns. Their members started living longer, so the pension plan could not meet this open-ended guarantee. Keep in mind that these pensions are an actual liability of the company, and if they cannot meet the required returns, they will have a pension deficit. And to meet this deficit, they will either need to make better returns, increase the contribution, or reduce the liabilities. And all these solutions are difficult to do. And because it's a company liability, then ultimately it may reduce the amount that is available to shareholders. So shareholders don't like this type of plan either. That is why there are very few companies today in America that offer defined benefit plans. Most plans you hear about are legacy plans, and most are likely shut out or closed to new or younger employees. The other type of pension plan you will see today is typically associated with municipal or state workers, such as firefighters or teachers. These are some of the largest pension plans that exist today. Let's take a look at one of the largest ones in the United States, and this would be CalPERS. CalPERS is California's public employee retirement system, and and it provides the retirement and health benefits for all municipal workers in California. I can find CalPERS on the terminal by simply typing CalPERS in the command line and selecting it in the dropdown. In this case, it has a Bloomberg ticker of 3162Z US Equity. You can find this or any other pension fund on the terminal within our PE database. To get there, you would type PEGO, and on the menu on the left, click Limited Partners, and then in the investor type drop-down on the next screen, you'd pick Government Pensions. Here you'll have a list of more than 700 pensions, and CalPERS is ranked number 3, but it is the largest in the United States. Going back to CalPERS specifically, when you have this loaded, you will see various tabs along the top, and that will include an overview of the fund, the various PE funds that they invest in, and their current open mandates for new money they're looking to fulfill. Each tab is pertinent info about the fund, but I wanted to focus on the Financials tab. This tab is important because it displays how the pension fund is investing its current portfolio. You can start by looking at the market value of the total assets. As we mentioned earlier, CalPERS, which is the largest pension fund in the U.S., has a significant number of assets, almost close to $400 billion. Looking at the other columns, you will see there is a target percentage. This is the longer-term allocation targets that are set by the pension fund and an actual column. So let's take a look at equities, for example. Here, the overall fund has a target of close to 50%, but currently they're only investing at the 48% range. So the portfolio manager of the equity group, and for a fund this size, there's probably many different subgroups on the equity team, are underweight equities because they tactically decided they wanted less exposure than the guideline or the target. This is a common occurrence where the actual manager of the various asset classes has the ability, within some degree, to use judgment to generate excess return. But overall, the fund will want to stay relatively close to the target percentage because those have been set and chosen based on the overall risk-return metrics the fund wants to adhere to. But today, the manager of the equity fund thinks that they want to be underweight equities. This could be for a number of reasons, such as maybe the equity team thinks that equities are expensive relative to history, or there's better opportunities in other classes, or simply they just can't find enough good investment opportunities and feel like, for now, they're going to sit in cash. Taking a look at the team structure, pension funds, especially larger ones, will have an investment management team structure. Those actually investing the money in stocks and bonds. They're similar to what we covered earlier with insurance companies, or for that matter, any other asset manager. And they have internal teams that will focus on each asset class. So in this case, they will have multiple equity and fixed income teams, but they will also have teams that will look out for their private equity investments as well. And the team structure of each of those groups will most likely be similar, and they will have a portfolio manager who will be responsible for looking out for the overall book of money, as well as analysts who will try and find new investments where they can invest in.
Some pension funds invest in alternative asset classes, such as private equity. PhelpGo allows you to screen asset owners that are private equity limited partners by performing custom searches. Use the screening criteria filters at the top to customize your search. In this example, we have screened by location and investor type. Who is the second largest government pension fund in the U.S. by total assets, and are they over-allocating or under-allocating resources to alternative investments compared to peers? Click Answer to submit your response. Correct. California State Teachers is the second largest government pension fund in the U.S. and is over-allocating to alternative investments. Click Continue to move on.
Next, we will look at endowment funds. An endowment fund manages the assets owned by an institution, typically a school, college, or university. An endowment fund typically receives its money from donations, normally alumni who want to give back to the school. These donations can be small or large, with the smaller ones typically coming in more frequently, and the larger ones, say maybe a $5 million donation or greater, less frequently, and the endowment fund manager normally does not know when they will get these large donations. All the money that flows into the endowment is managed for the benefit of the school or institution. The money from the endowment will be used to provide scholarships for students, fund research, or just manage the annual operating expenses of the school. Similar to other assets, this pool of money is managed internally by different groups at the firm. So they will have an amount allocated to equities, and there will be a team or multiple team that focuses on managing the equity part of the portfolio. You can see this information we have on various endowments by typing ENDO GO on the terminal. Here you will see a list of large endowments at the top. Hopefully you're an alumni of one of these schools, because some of these larger institutions have very large endowments with total assets of the top schools in excess of $40 billion. As always, returns are important, but risk is also a critical aspect of the endowment. Endowments will look at the size of their assets they invest, but more importantly, the amount of risk they are willing to take will be determined by many different factors. One large factor that will determine the risk is the amount of liquidity that the endowment needs to provide in any given year. For example, if an endowment is required to provide 15% of its total endowment every year for operating expenses, then they will probably be a lot less willing to take risks, because each year they will need to make sure that they have enough liquidity to meet those current obligations. Similarly, a large fund could be willing to take more risk because they don't have the annual cash requirements a smaller endowment may have. Just like any other asset owner, these endowments are managed by teams that focus on various asset classes. So there will be people focused on equity asset class and those that focus on fixed income, and some may focus on private equity. One note, though, is recently some large endowment funds have done away with active management of their endowments and have outsourced their investments to other third parties, such as asset managers, or in some cases they invest directly in ETFs. We have to see if this is a trend and other endowments follow suit. Sovereign wealth funds get their money from the sale of some sort of natural resource, like oil or lumber. As the country sells, say, oil, for example, on the open market or to third parties, they get cash in return. The cash is then put in the sovereign wealth fund, and they manage this money. As you can see, a sovereign wealth fund typically gets money into the fund on a frequent basis. The sovereign wealth fund manages this money for the benefit of its citizens, so potentially a country could provide free health care, or some may have a low tax rate because a large portion of the money they get goes to benefit those citizens. We can see all the sovereign wealth funds we have on the terminal by typing PEGO. Click on the limited partners on the left, select the investor type, and choose sovereign wealth funds. And this will give you all of them that we have in our database. Sovereign wealth funds have an investment management team structure, those who are actually investing the money in stocks and bonds, and they normally focus on asset class. So in this case, they may have multiple equity or fixed income teams, but they'll probably have those who look at private equity investments as well. The team structure in each of those groups will be similar in that a PM will be responsible for the book of money, and analysts will help with finding new investment ideas. So now that we have looked at the 4 types of asset owners, we've come full circle to the information we spoke about at the start of the video. While there are many differences between asset owners in terms of the assets they invest in and how much risk they are willing to take, they all have 2 common factors. They are investing large pools of money, and these inflows are typically received frequently. And internally, the teams are structured just like asset managers in that they have a portfolio manager who manages the fund and analysts who help the PM with specific investments.